Shall I start? According to today's my plan, right? I am planning to conduct lecture until 9:30, 9:35. So then we will have 10 minutes break. So we are continuing the presentation until 11. Right? Is it okay? No option. So I will continue the capital budgeting this lecture. Last week we discussed up to cash flow estimation. I think you remember. Okay? We discussed cash flow estimation, initial cash flow, and annual cash flows during the life of the project, after tax basis, and also terminal cash flow after adjusting the scrap value and any tax advantage on the scrap value. So we have to consider this thing. I hope you learn this point. So if I correct, I went through this example also. Right? So give the answer and I asked you to check and do this one at home because I was a bit rushed with that one as I remember. So I gave this to you, this answer. So I hope no any issue on this calculations. Okay, very simple. So I promise you to do another one related to the cash flow estimation. So this is from your tutorial. Yes, from your tutorial. So quickly let's look at this example and we'll see whether you can manage yourself. Now we discuss. We are in the capital budgeting process. In the process, you have to estimate cash flows in order to evaluate the project. So to evaluate using the criteria like MPV, IRR, payback period. So first you should know what are the net incremental basis. We are estimating cash flows on incremental basis. So initial annual operating after tax and also non-operating after tax terminal cash flow we have to estimate. So this is another example I have put in your tutorial. So let's look at this one whether you can do this. I think it is also similar to the one we discussed. So for the exam, you should be able to do a picture like this. LFPS is planning to replacing the existing machine in the production plant. The company has estimated that the cost of the new machine will be 4.5 million and installation charge will be 500,000 rupees. The useful economic life of this new machine is 5 years. LFPSA anticipates that the improvement of the production facility with the new equipment will have positive impact on its annual earnings. As a result, the after-tax net cash flow is estimated to increase by 1.5 million in the first year. Thereafter, it will grow further by 5% per annum during the remaining life of the new machinery. By the end of the useful economic life, the new machine will be fully depreciated and its residual will be 750,000 rupees. The new machine also has an additional net working capital requirement 800,000 which is required to be made at the beginning of the operation. This net working capital requirement will remain unchanged throughout its life, and then tax rate is 30% and cost of capital 15% per annum. So you can estimate the initial cash flow, annual after-tax net cash flows from year 1 to 5, terminal cash flow. So others we have to discuss. Shall we do this one quickly? So you can, because we did example, so now you can do this one. So this is again 5 years. So 0 to 5. Cost of the new machine will be 4.5 million and the installation charge will be 500,000. So at 0. Initial cost 4.5 million and there is the installation charges 500,000. Life of this new machine 5 years. With the improvement of this machine, there is a positive impact on annual earnings. Annual earnings. As a result, the after-tax net cash flow. The after-tax net cash flow is estimated to increase by 1.5 million in the first year. Now here, you have to note that you are given not the earnings. In the previous example, it was you have to calculate profit, then you have to deduct the depreciation, taxable income, after tax profit, and then you have to add back the depreciation to determine the cash flow, operating after tax basis cash flow. But in this example, you are given is it profit or cash flow? It is cash flow, 1.5 million. So you can see as a result, the after tax net cash flow, even after tax. So this is easy. So after tax net cash flow, so then is it required to add back the depreciation? No, because depreciation already added here because this is a cash flow. So you can take this as it is for the evaluation of the project. So after tax cash flow, year 1.5 million, but it is increasing by 5% per annum throughout the life. Thereafter, it will go further by 5% per annum during the remaining life of the machine. So you have to increase it by 5%. During the remaining of the life, by the end of the useful economic life, the machine will be fully depreciated and its residual value will be 750. So therefore, the 750 is now totally a profit. So you can arrange the answer like this, right? I am doing this in the Excel. So for 5 years, table like this. So there is a additional net working capital requirement of 800,000. So it remains constant throughout the period. So you have to admit here increase of the net working capital 800,000. So 750 is the residual value. So the machine now has depreciated totally. So therefore this 750,000 is a profit. So on that you have to pay tax. This is totally profit because machine is totally depreciated. So therefore the salvage or the residual value is profit on this project. So that is you have to consider as a profit. So on that you have to pay tax. So after tax salvage value is how much? Or after tax residual value? 750, on that you have to pay tax 30%. So it is then 525,000. Right. So now at the terminal year you have to release the net working capital because the project is over. So there is no any capital requirement. So that is also we have to consider here release of the recovery in the net working capital requirement. So that's all. Eh? That's all. So this is easy, not like the previous one even. So then these are the so the cost of the project you can estimate with the installation charges and all. Yes, 0. $1.3 million. Cash cost for the through the life of the project. So terminal year cash flow is this plus. So these are the cash flows related to this project. Initial investment is 1.3 million. Is it correct? 1.3 million. So here 150,000. 150,000. $157, $165, 70, and terminal year 1.5 million, 7,326. Harry, is there any questions? How's it starting? Yes, yes. No, nothing. 4.5. How did you feel? So with the if the cash flows are given, so you have to consider like this. In addition, I just went through your tutorial. This one. This is also related to the cash flow estimation. I think you can see this one. I will discuss this under the model paper. So it means that you will have a question similar to this one in exam to estimate the cash flow. So I will discuss this one in the model paper. So you may look at this one. So there are some things, more activities because unit sales are given. So you have to estimate revenue and the things. So likewise, so let's discuss this one in the next week. I will take 1 hour to discuss the model paper next week. Now it is okay here. May I answer again? Huh? Any mistakes? Method is 1.5 million. Method yeah. This is 1.5 million. Huh? 500,000. 500,000, 4.5 million. How do you know the 500,000, 800,000. For the first 5.8 million. These are the incremental after tax basis cash flows. Terminal cash flow 3.1 million. Right. Okay. Right. So now we are going to the remains things in the. Now in this section also you are asking to evaluate this project whether it is feasible or not. So that part actually we have to discuss. So we have to evaluate this project whether it is a feasible one or not. Right. So now we can do the remains in the capital budget. So now if you look at the following questions 2, 3, 4. So to do that part, you should know what is this evaluation criteria and how to use them for the decision making. So therefore now we are going to discuss that part. So under the evaluation criteria, so you can identify discounted based evaluation criteria and the non-discounted based. Right? And discounted based and the non-discounted based evaluation criteria. So if I ask the question, what is the difference between discounted and non-discounted based? Now you have learned when we say the discounted cash flow, how it differentiate from the non-discounted cash flow. What is the difference? Yes. Now, if you look at this accounting rate of return payback period, they are not They are not the cash flows adjusted for the tax credit. They are asking when you are computing. As we should be doing, other presentation right. Non-discounted means they are not adjusted for the time value of money. So the payback period, accounting rate of return, we are using this criteria considering cash flows as it is. Right? Considering cash flows as it is. So discounted cash flows based criteria means, so when you apply the NPV, IRR, profitability index, so there we calculate these indexes or these values considering the time adjusted cash flow. So that is the difference. You correct. So let's start with the one payback period. So this is very simple. Even anyone can understand what is this payback period. So simply payback means how many years or how many months will it take that particular project to cover the initial cost, initial year expenditure, or the initial investment. So that is we call payback period. Right? So that is the years required to recover the initial cost of the project. So payback period you can calculate using this formula, this one. If annual after-tax cash flows are identical each year, so then you can apply this formula to identify where the payback. Right? But now you can see that previous example we just finished. So annual cash flows are increasing by 5%. So they are changing. So then you cannot apply this formula. So then manually by considering cash flows year by year, so you have to calculate where the payback period. Where the payback period. When it comes to this payback period, in literature or in theory, there is no any standard payback. Now, if you take the net present value, that is very clear. If it is positive, we can accept the project. If it is negative, you may reject. So, likewise, decision rule, decision criteria is very clear. But when it comes to this payback period, there is no any standard payback. It depends on the company, industry to industry, that particular director board expectations. So likewise, that is very subjective. So when you are evaluating with this payback period, so you have to compare this standard payback with your calculated payback. 1 minute, right? Right. And so then there is no standard payback. So you can compare the standard payback with the calculated payback to take the decision. If your calculated payback less than the standard payback, you can accept the project. If the calculated payback is greater than the standard payback, that is you have to reject. What is the standard payback? Suppose that particular company, they have some idea, they have some feelings, their initial investment of a project or investment, they need to recover in the 5 years. So that is their decision. That's subjective for this particular company. So that is we call payback period of that company, standard period. This point is important. When you are comparing two projects or two investment using the payback period, so you cannot compare if these projects initial cost is different. Right? Suppose there is a two projects like this, A and B. Right? Say A and B. Say initial investment project A 500,000, project B 600,000. So you can calculate payback period for project A and project B, but you cannot compare because the initial cost for these two projects are different. So when the two projects initial investment is different, you cannot use the payback period to compare two projects. That is important when you are assessing a project using the payback period. And also remember, by using only the payback period only, you cannot take any decision because there are certain limitations I am going to discuss next this thing. So because of this limitation, if you are evaluating project using payback period only, you might end up with the project may not create value. So therefore there is a lot of limitation. So only purely based on the payback period, we cannot take the decision. Right? Right. So these are the advantages and the disadvantages related to the payback period. Very simple. Anybody can understand this one. Very simple. This is as advantages. And the other thing, this payback period has a strength as a measure of the liquidity. As a measure of the liquidity. Now suppose these two projects, you have calculated payback period for these two projects. Say payback is 4.2 years. Right? 4.2 years, or in months 4 years, and if you convert this into months, this is 4 years and how many months? 0.2 means 12 divided by 0.2. 6 months then. This is 4.2 years, or if you want to express in terms of the months, 4 years and 2 divided by 12 divided by 0.2. නෑ මේකේ භාගයයි 0.2 කියලා කියන්නේ අවුරුද්දට මාස 12යි 0.2 කියලා කියන්නේ ඒකේ භාගයක් කියන එක ඒතකොට sorry you are 12 into 0.2 4 years and 6 months approximately 4 years and 6 months 12 වැඩි කිරීම 0.2 12 දෙක වැඩි කරලා 2.4 and 2.4 කියන්නේ එතකොට approximately 2 months. Right. Anyway, if it is in years, you can convert it into months simply years into 12 months. So that is then approximately 4.2 years. Or say 4.2 years. And 0.2 කියලා කියන්නේ අවුරුදු මාස වලින් කියනවා කොච්චරද? Suppose here this is 5.8 years. The months are in 5 years and 10 months. 10 months. 5 years and 10 months. Right. So these are the payback period for these two projects. Now, suppose initial cost for these two projects is same. 500,000, 500,000 are same. Now, if you are going to select one, which one you may select? A or B? Yes, you may select this one because the payback is low. So initial cost you can recover within the 4.2 years if you accept the project fund. Here project B 5.8 years. So these are the two strengths in the payback period. It provides, or we can use as a measure of liquidity. So what is the liquidity? Liquidity means the ability to recover or ability to generate the cash flows from the project. So that is the liquidity. Now, if you consider these two again, which project has high liquidity? A or B? Project A. So lower the payback period, it implies that this project is generating cash flows. It has high liquidity. So that is the meaning, lower the payback period. So you can recover the initial cost early time than the other one. So therefore it means that there is a high liquidity, this project. That is correct. So then if you consider this A and B, so which one is with the high liquidity? Project A. Because its payback also compared to B low. Which project has high risk? A or B? Which is with the high risk? What is the risk? You can remember time value of money over the time. If you have to wait long time to recover a certain cash flow, that high risk. Higher the risk, higher the required rate of return, higher the discount factor, higher the cost of capital. The main connections of who they are. So now by looking at this payback period, you can assess the riskiness of the project to a certain degree. So now if you consider this A and B, which is risky? A or B? B, because you can see its payback is 5.8 years. Compared to the A, it is higher. So therefore, this project is risky. This is with the high liquidity. A, this is risky. So these are two strengths or the advantages of the payback period. You can use this payback period to assess the liquidity of the project. And also you can have some understanding about the riskiness of the project by looking at the payback period. So these are some strengths. Limitations, it ignores the cash flow after the payback period. That's the main limitation. So this A, project A, it says this is the payback. So what will happen to this project after the payback period? How about the cash flow patterns? Are they negative or what is the trends or nothing it says? It doesn't say anything about the cash flows after the payback period. Just say this is the payback. So therefore, this payback period is not or it doesn't show the overall effectiveness of the project. Profitability means that is overall effectiveness of the project. When you are calculating payback period, it doesn't consider the total life of the project. It simply calculates where the payback period. But this project may run for another 5 years, another long period. So it say nothing about what happens to this project after the payback period. So therefore, not true measure of the profitability. That is, you cannot overcome. It is very unique issue with the payback period. You cannot get understanding about the overall effectiveness or the profitability of the project by looking at this payback period. It ignores the cash flow after payback period. Even though you calculate discounted payback period, still these two problems are there. It ignores the cash flows after the payback period. It ignores the time value of money. It's a problem, but you can overcome. How? You can overcome by calculating discounted payback period. So this is based on the cash flows considering as it is. So you can calculate time adjusted payback period, or we call discounted payback period. So then that third limitation maybe you can overcome. It's not a problem. But first two, it's profitability. It doesn't say anything about after the payback period. So that is even with the discounted payback still there. Right? So because of this severe problem or the limitations of this payback period, if you take the decision based on the payback period only, so all it depends on the payback period, you might end up with a project that may not maximize shareholders' value, that may not create value for your business. So that is why I mentioned payback period is okay. It's a very good measure. You can have some idea about where the liquidity, which one has riskiness. But anyway, only using the payback period, you cannot finalize the project. That is the conclusion. We lead to the decision that do not maximize shareholders' value. Right, now let's calculate payback period for these two projects. There are two projects. For the project A, project B, the other payback period. Now you cannot apply the formula because you can see cash, incremental cash flows in the life of the project are not identical. So you cannot apply the formula. So one by one, you have to consider the other payback period. So initial cost for these two projects are same. So we can compare 120 So the project A, so initial cost is 300,000. Where the payback period? So in year one, you can recover 120. So at the end of year one, still there is so you can recover 120 in the year two. So you have 180 in the cost. From that you can recover 60,000 is remain. So exactly 3 years, no? Yes, for the project A, exactly 3 years is the payback period. Is 3 years for the project A. Then project B, initial cost is again 300,000. So year one you can recover 90,000. So it remains 280. From that you can recover another 90,000 in year two. So remains 120. From that you can recover another 75,000. 9,000. 30,000 remains. So from this 30,000 you can recover in the year 4. How many months? Around intake. So payback period for the project B is 3 years and 3 years and how many months? So payback for the project B BSN from the year 4 you can have 75,000, right? 75,000. From this 75,000 you need to recover 30,000. So 30,000 divided by 75,000. So it is around 4.8. It means 3.5 years. Years වලින් ගන්නවනම් මේ කීයද මෙතනට? මේකේ years වලින් 30,000 බෙදීම 75,000 0.4. එතකොට equity years 3. මේක එක විදිහකට හදන්න මානස හරි years and වශයෙන් මේක බෙදුවම 0.0 නෑ 0.4. So 3.4 years. This is years. So if it is months, then 0.4 into 12, 3 years and 5 months. So this is the payback period. So for the exam, you can use either this one or in months or whatever, that is correct. So you can have the answers. 3 years exactly for the project A. Project B 3.4 for 3 years and 5 months. Right. So now you can see you can have a decision. If I ask again, which is risky? Which project is risky? A or B? B. Which has high liquidity? A. So you can take decision based on that. Now I told you that one of the issue with this payback period is that it doesn't consider the time value of money. So here when you are calculating this payback period, now if you take this 90,000, we expect that 90,000 1 year from now. This 90,000 2 years from now. And the third one 3 years from now. So without considering this time differences, this 90,000 390,000 you have taken as it is. You have taken as it is. So without considering the time. So that is not correct because you know that there is a time value. So now you can overcome this problem that it doesn't consider the time value. You can calculate payback period again considering discounted cash flow. So you can convert this 90,000 its present value and the 90,000 expecting the second year its present value. So likewise you can adjust this cash flows to the time value if you know the cost of capital, required rate of return of the project. So using that you can calculate time adjusted cash flow. So then based on that you can calculate the payback period. So that is we call discounted payback period. So that is better than the traditional payback period, because one issue, one limitation was with the payback period, you can overcome by calculating discounted payback period. So if the cost of capital or the discount rate, if it is 12%, so calculate the payback period for the project A. So you can see here, the answer is there actually, but anyway, better to calculate this one, because these numbers just writing not enough. So how this number is coming? Now this is for the project A or B. Project A. Yes, this is project A. So you can calculate discounted cash flows using 12% as the discount factor. So these are the discounted cash flow. Now you know how to calculate this discounted cash flow. 120,000. Now if you draw the timeline for this project, this is like this. No need to elaborate more. Now if you draw the timeline for this project, it is like this. So I am investing here 300,000. This is 5 year, 1, 2, 3, 4, 5 years project, not 5, 6 years. So 1 year from today, expected incremental cash flow 120,000. Year 2, 120,000. Year 3, 60, 60, 60. So likewise, 60,000, 60,000, 60,000, 60,000. So these are the expected cash flow. So then you can calculate payback considering these cash flows as it is. But there is a problem with that. So what you have to do, you have to discount these expected cash flows to the present. All these cash flows to the present. Considering the 12% as the cost of capital or the project required rate of return. So then you can have the discounted cash flows here. So then calculate payback period considering this discounted cash flows. So now all these cash flows are in year 0. So these are adjusted for the time value. So now if you calculate the payback period, that is we call discounted payback period. So these are the discounted cash flows at 12%. You know how to calculate it. Now this is expected 1 year from now, 120,000. So in order to get its present value, you have to discount it for 1 year. This is expected in 6 years from now. 6 years. So to get its present value, you have to discount it for back 6 years. So then you will get the discounted cash flow. Right? So this is for the project A, discounted cash flow, basis value, 4.48 years. Without considering the time value, time differences, what was the payback for the project A? 3 years. Now it has extended to the 4.48 years. So it go further because after adjusting for the time difference. Right. So now you calculate discounted payback. Just looking at this not sufficient. So you have to do the calculation. Calculate this one for the project B. So this is the answer for the project A. It's given to now. And then all cover make a hadalne of the River or Karpada and Ranbad, Venaga and then 4.5 so you have to do it. So let's calculate payback period for the project B. This one. Yes, for this project. Project B. Right. For the project B. How much the pay discount to pay back? Is it 5.23 years? Right, it is 5.23 years. So you can see there also payback period are extended for more years because of the adjusting for the cash flow time value of money. Right, I think that's clear. So now next one is accounting. Any question on the payback? Nisala and some of you requested to have the online presentation, but I can see some cases today they have come for the presentation. So if I do like this, is it unfair to them? Huh? Huh? So then I have a chance, no problem. So we'll do like this. Yeah, I will continue this one today. So then next week I can do the capital structure and the model paper. So then your sessions are finished, I think. So, so you have to upload your presentation. When you are doing, I will give some guidelines at the end. So you have to on your video and the things. Few things I have there in your books also for the clarification. I will talk later. Right? So we do like this. The last row. මොකද දෙන්නමාවේ ප්‍රසන්ටේෂන් එකේ කාලෙකට පස්සේ දැක්කේ then after first 2-3 lectures වල හිටියා වගේ මතකයි. So after that disappeared. Then is it okay? Huh? So then next one is the accounting rate of return. This is actually the based on the accounting information. Based on the annual report data. This one you can see the formula ARR, or we call some textbooks mention this as average rate of return, or we can say accounting rate of return. Simply is equal average profit divided by average investment. So profit to investment. So profit, you know that is the income statement based calculation. It's accounting profit. So the average investment normally we can consider if there is a investment in the initial year and throughout other periods, so you can take both initial and the terminal year investment divided by 2. Or in some textbooks, when you are calculating this average investment, they have taken simply average. If you have 5 investments throughout the life of the project, so total of that divided by 5. So likewise also it is calculating. There are certain deviations in the accounting rate of calculation, but I have put some this formula. Here Y0 means that is initial investment. Here this is terminal year investment divided by 2. So that is we take as the average. So this is the accounting profit. So you can see EBIT mean earning before interest and tax. This is after tax profit, net income. So that is its average. If you are considering, suppose the project life is 5 years, so you have to calculate EBIT for the after tax basis for the 5 years. So that average we are taking as the average profit. Throughout these 5 years, if there is some investment, so that is also you have to take as the average. So average profit divided by average investment into 100, we consider as a IRR, or the accounting rate of return. When it comes to this one, again there is a problem, because you know that when you are taking the profit, there are certain limitations, certain problems in the profit, because it's not a cash flow, it includes some non-cash item, so it can be manipulated, certain limitations are there. But here we consider that limited profit to calculate the ARR. What is we how to take the decision actually? Again, this is also theoretically there is no any hurdle rate or the benchmark to compare this calculated ARR, accounting rate of return, with that kind of number. But anyway, some textbooks you can better to mention that considering this minimum rate as the company cost of capital. Right, I have not put here, you better to note it. So you can compare this accounting rate of return with the cost of capital. If ARR is greater than the project cost of capital or the average cost of capital of the company, so you can accept the project. If this ARR calculated number less than the cost of capital, so you may reject it. So this minimum rate sometimes we proxies with cost of capital, or the project required rate of return. Right, so this is again a very simple one based on the income statement and the cash flow. You can calculate. I want to tell you that you may read that Pandey's chapter. It is explaining this accounting rate of return calculation. When there is a depreciated of the initial investment, so there are certain adjustment to calculate this average investment. So you can take half of the investment as the average investment. Certain things are there to consider when related to the different complicated project when you are calculating ARR. So you better to read that chapter for your understanding. But this is the standard accounting rate of return calculation formula. Now suppose you are given the information like this. These are the year-end investment for a particular project in the 5 years. This is EBIT, earning before interest and tax. So If tax rate applicable is 30%, so you have to calculate accounting rate of return. So just to practice, just calculate the ARR, accounting rate of return using this formula. So these are the investment. You can see throughout the life of the project, there is an investment. So you can take the average investment considering our formula here. Initial investment plus terminal year investment divided by 2. So average investment is equal like this. ARR is equal average profit divided by average investment simply. So average investment you can take here 200,000 plus 100,000, 100,000 divided by 2. This is the average investment. So average profit you have to calculate. So EBIT for the each years are given. EBIT. This is before tax basis. So then you have to calculate EBIT after tax for each year. So initial year there is no EBIT. Year 1, EBIT is 40,000. 40,000. So after tax profit, after tax net profit EBIT operating profit is equal this into 1 minus tax rate. Tax rate is 30%. So likewise, for this 5 years, you have to identify after tax EBIT 44,000 into 1 minus tax. So then calculate the average profit here. Tax rate is 30%. average profit here 33,600. So then ARR will be average profit divided by average investment is around 22.4%. Right? 22.4%. I think that is correct. I think also there. This is that's 22.4%. So this is the accounting rate of return. So you can compare this with the company cost of capital. If there is a minimum or the standard rate for the company, so that is we can use. Otherwise, in some textbooks, it is using the project required rate of return or the project cost of capital to take the decision. Suppose now project cost of capital is 12%, project required rate of return is 12%. So what is your decision? Suppose here project cost of capital or the project required rate of return is 12%. So then what is your decision? Accept or reject? Reject. The accounting rate of return is 22.4. The minimum required rate of return of the project 12%. So then you can compare that one with the project cost of capital. Project cost of capital means that is their minimum required rate of return. So that is a way of taking decision using the accounting rate of return. So what are the certain limitations? I think all of you have get the answer. Any question? So these are the advantages and limitations. Use accounting data. Calculation is easy because average profit and the things are available. Very simple. Problem again, it ignores the time value of money. You know that when you are calculating the profit, it didn't do anything for the time value. We adjust nothing in the profit calculation in the income statement for the time value of money. It does not consider the cash flow. You know that when we say the profit, non-cash items are included. So that is also another problem. No definite method to determine the cutoff ARR. There is no any theory, any hard and fast method to determine that. In some practices, some companies they are using cost of capital. Or they may have some their cutoff rate. Depends on that industry, that company investment budget, certain factors. There is no proper cutoff for the ARR. These are the characteristics. So under the non-discounted cash flow based valuation technique, we can discuss these things. Now we are going to the NPV. Net present value. Under the discounted cash flow based calculation. Right. So net present value (NPV) is the one of the most superior, one of the prominent method in the project evaluation. Because of its some uniqueness characteristics, so you can I can have the decision based on the net present value. So what is the net present value? It is simply the difference between present value of the cash inflow and the present value of the cash out. So I think in the areas also in the budgeting part, you have to consider this NPV calculation. So that is, you can see present value. So we are using time adjusted cash flow, right, after considering the time. So that is, we call net present value. So normally when we are calculating the net present value, so we use the project cost of capital or the project required rate of return as the discount factor. So decision rule is very clear. If the net present value is positive, suppose we are evaluating the project, its net present value is positive 100. So that means the difference between the present value of the cash inflow and the outflow, the answer is 100. NPV is positive 100. So means that by accepting this project, ultimately, so you can increase the value of the company or the wealth of the shareholders by 100,000. Right? So this is aligned with our objective of financial management, that is maximizing shareholders' wealth, maximizing shareholders' value. So by accepting this project, you can create value. You can create, increase the shareholders' wealth by 100,000. That is the meaning. So therefore, when the NPV is positive, you can accept the project. If NPV is negative 100, it means that if you accept this project, ultimately you are end up with the decrease of the wealth. You will end up with the decrease of the value of the company by how much? Approximately by 100. That is the meaning. So therefore, you may not accept the project when the NPV is negative, when the net present value is negative. Net present value can be zero. If the present value of the cash inflow is equal to the present value of the cash outflow, NPV is zero. Marginal project. So no increase in value, no decrease in of the value. This is a marginal project. So either you can accept based on the available real options, because this is a long-term project. So if you have certain real options, these are very critical areas in the capital budgeting. So board of directors or the finance manager can decide either to accept or reject based on the certain other factors. Right? Because the NPV initially is zero, it means that no value creation, no value decrease. So the decision rule is very, very clear. Not like the payback, not like the county rate of it. Another thing that you should know when you are calculating the NPV, the reinvestment assumption. Right? What is this reinvestment assumption? You know that this project or the investments are long term. So that is go beyond the 1 year at least. So reinvestment assumption means throughout the life of the project. Now if you take the initial previous example, year 1 you are generating some cash flow from the project. So this cash flow throughout the life of the project you are reinvesting. एक लाख में किया कितने a generated return that cash flow you are reinvesting at least what is the rate cost of capital. Reinvestment rate, when you are calculating the NPV, the implied reinvestment rate is the cost of capital. So cash flows generated through the project are reinvesting at cost of capital. So doing like this NPV is generated. Right? By reinvesting the generated returns, generated cash flows throughout the life of the project, so this NPV is generated. So therefore, this is very important. Reinvestment assumption is cost of cash. So cash flows are reinvested at the cost of capital or the project required rate of return or average company cost of capital. This is very conceptually, theoretically, very clear evaluation criteria. It's aligned with our objective of the financial management. It's used the time adjusted cash flow. Reinvestment assumption is very clear. When you take the reinvestment assumption as the cost of capital, the cost of capital reflects the current expectation in the current investors' expectation in the market. This cost of capital, how we determine the cost of capital? Can you remember? Cost of debt, cost of equity, cost of preference shares, and the overall value. So that debt cost, equity cost, preference share cost is coming from market, from that investors' required rate of return. So therefore, this cost of capital is very realistic reinvestment value, reinvestment percentage. It's very close to the market expectation. It represents the existing investors' required rate of return. So therefore, this reinvestment assumption is very strong when you are calculating, when you are generating this net present value. So these are the important characteristics. I think I explained some of them. Consider the time value of money, yes, because NPV is equal present value of the cash inflow of the project minus present value of the cash outflow. That is the NPV. So time adjusted cash flows are considered. Cash flows are considered, yes, not like the ARR. In the accounting rate of return calculation, average profit, not the cash flow. But here, this is purely cash flow basis. So that is another characteristic. This one. Assume that cash flows over the project life is reinvested. Please note down at cost of capital. Reinvested at what rate? At least this cost of capital. If may cost of capital may minimum required rate of return reinvest may be generated. Really, it was a wedding investment, but this is our minimum required rate of return. So cash flows throughout the life of the project is are reinvested at cost of capital. Absolute measure of the wealth. Yes. If NPV is positive 100 rupees, it means that by accepting this project, through this project, you can increase the wealth value of the company by 100,000. 100 rupees. Market price of the company share will increase by 100 rupees. So this is the absolute measure of the wealth. NPV is the absolute measure of the wealth. It indicates if it is positive 100. So through this project, you can increase the market value of the company shareholders' wealth approximately by 100. That is the meaning. Positive NPV increase owners' wealth through this investment process. Negative NPV is decrease the owners' wealth. So therefore, this is very clear, conceptually, theoretically very strong evaluation criteria. Right. If you have any question, you can ask. Now there is a small project. This is 3 years one, I think. The cost is 200,000. Net cash inflows 50,000 year 1, 100,000 year 2, 150 year 3. Discount rate or the project cost of capital is 12%. So what is the NPV? What is the NPV? Calculate it. So NPV is equal present value of the cash inflow minus present value of the cash outflow. That is the NPV. So what are the inflows? Net cash inflows. Net after considering inflows, outflows, all the expenditures. So you are provided net cash inflows. 50,000 in year 1. 50,000 year 1. 100,000 in year 2. 100,000 year 2. And 150 in year 3. So these are the inflows. So you have to calculate present value of these cash flows. So you know how to calculate by discounting. Cost of capital discount factor is 12%. You have to discount back for 1 year. This is back. You have discounted for 2 years plus this is for 3 years. So these are the present value of the cash inflow minus present value of the cash outflow. This is a conventional type project. There is an initial investment. After that, there are only inflows. So present value of the cash outflow is equal. Initial investment is 200. So that is at year 0. So you can take this 200 as it is given. So it's happening in the year 0, initial year. So that means into 0. 0 can take, right? So you can take this 200,000 as it is given. Yeah, how much the NPV? Is it what is positive? 31,120. It is positive. So you can accept it. Because project with the positive NPV, it means that by investing this project, the company value can increase by 31,129. So when you are doing this investment, there is an implied reinvestment assumption. It is implied. Right? Implied. This 50,000 receiving in the 1 year from now, you are reinvesting for 2 years. That is the meaning. This 100,000 receiving 2 years from now, you are investing for another year. So that is the implied reinvestment assumption. The key of the reinvestor actually set the 12% cost of capital. So through this process, this 31,129 is generated. It is possible. Right. So this is very simple. Yeah. Right. So then next one is accounting rate of return. Do you need a break? Huh? Maximum 10 minutes. Come back in 10 minutes. There is no presentation. May I have some clarification on the groups in the main group meeting. Group number 2 කියලා කොහොමද දැන් මේ analyzing financial infrastructure the financial system එකේ you may come with the break. I will show you the document. Come within 10 minutes. If you can see just 1 minute, where CPN numbers are the given in my sheet 3, 4, 6, 7, 31. Huh?
24.
31 කියලා කෙනෙක් ගන්නද? It's a mistake නේ. හරි. එනවා අනිත් එකේ මේකේ group number 5 green bonds කරපු කට්ටිය 4 මේ sorry නේ සමහරවිට තියෙනවා. අනේ අපේ 10 15 alright පහළ තියෙනවා ඒක ඉෂුව කරන්න. එයාලගේ references list එකක් තිබුණා. hari pakai gitu. Misalnya pahalo ignored hari, no issue with it. List of preferences missing. पहाड़ों में पहाड़ों रिपोर्ट की भी she is not doing मैं अब हम लाखों दाना बचने समय के आप में इलेक्ट्रिसिटी का इधर देते हैं right have a break and come with 10 minutes please Sorry for that because it's not my decision, right? So students are requested because I was planning to do that physically. Huh? So this one is the accounting rate of return. So again, actually, this is not the new thing for you. ARR, sorry, IRR, internal rate of return on the accounting. So you can remember in the YTM calculation, in the bond valuation, so you calculated yield to maturity. What is that yield to maturity? Can you remember? So it was that if you buy this particular bond today at its current market price, and if you keep it until its maturity, your realized yield is the market, right? So in other words, that is the discount factor when the present value of the expected cash coupon and the redemption price, when it is equal to the current market price. The discount factor is the YT. So related to the project, that bond investment also kind of an investment. So that same thing, at that time you define it as a YTM, now we call it is IRR. So this is internal rate of return, so you can calculate for the project. So this internal rate of return shows internally generated rate of return for a project, IRR. Right, so that is discount rate which equates the present value of investment cash flow and outflow. We call it internal rate of return. So therefore, with that first bullet, with that explanation, you can realize that at IRR, NPV is 0. At IRR, NPV is 0 because that NPV IRR means is the discount factor, discount rate, where the present value of the project cash inflows equal to its cost. Present value of the project cash flow, cash inflows and present value, cost samana rate of return. That is the IRR. So then NPV is 0. So theoretically, what is the IRR? Actually, it is the project intrinsically generated rate of return without any impact, without any influence from the external factors. IRR is a financial metric used to estimate the profitability of the potential investment. It shows how much the rate of return generated through this investment. So when we calculate this bullet, it says IRR is internal. It is intrinsic to the project. Because we calculate its internally generated rate of return. Project is doing any rate of return. It is intrinsic. It only depends on the cash flows of the project. Right? So when we calculate this IRR, you can remember that one also, the reinvestment assumption. In the NPV calculation, our reinvestment assumption, that is cost, we reinvested at the cost of capital. In IRR estimation, reinvestment is IRR. Right? When we calculate the IRR, we assume, that is implied assumption, we assume that the cash flows generated to the project are reinvesting at internal rate of return at this particular IRR of the project. Is the here this last these are different definitions for the IRR, right? So it's the discount rate. Is the discount rate that makes the net present value of all cash flows equal to 0 in a discounted cash flow analysis. So you can see technically, so you can see this is the present value of the cash inflows. This is the present value of the cash outflow. So that difference is equal to 0. So when the present value of the cash inflows is equal to the present value of its cash outflow, so that discount factor, this is our discount factor, R, we call as the IRR. Discount rate which equate the present value of investment cash flows and outflows is its IRR. So therefore at IRR, remember NPV is 0. At IRR, NPV is 0. So that simply, what is the IRR? Discount factor when the NPV is 0. Technically, that is the IRR. Theoretically, what is the IRR? It is the project intrinsically generated rate of return. In the YTM calculation also, we did the same thing. Bond එක අද රුපියල් 850කට අරගෙන ඒක මැචුරිටි එක ළඟ තියාගත්තොත් ඒ coupon මේ විදිහට ලැබුණොත් maturity payment එකත් ඒ විදිහට ලැබුණොත් ඔයාගේ generated rate of return එක තමයි YTM. That was the YTM. So YTM is another term used for the IRR, internal rate of return. So you can see the acceptance criteria. That is also very clear theoretically. If IRR greater than company cost of capital, you can accept the project. If this IRR less than the cost of capital of the project, you can reject. If these two equal, IRR and the project cost of capital is equal, either you can accept or reject. And also remember, this is for the conventional type projects. What is this conventional type project? I think later it is there in the slides also. Conventional means, so in here, now this is conventional. Initially, you are investing at 0. So after that, cash inflows. So this is conventional type project, traditional project. So you can see the signs are changing only one time. Non-conventional project means, suppose initially you are investing, so there are cash inflows after that for 2 years. There is another investment, again there is a cash inflows, again there is an investment. So this is not the conventional type project. So these are the real type of projects. We are investing in a different time period throughout the life of the project. These are we call non-conventional project. This is conventional type project. There are many examples gone all in your this examples for this discussion. So we are taking this conventional type project, right? Conventional type. The conventional type project minus and plus signs are changing only one time. But if you look at here, changes are more than one time. That is non-conventional. Invest කරනවා cash inflows තියෙනවා I invest කරනවා I inflows තියෙනවා I invest කරනවා සමහර period වල cash inflows නැහැ. So these are non-conventional, right? So in evaluating this non-conventional project with the IRR, you have a problem. So you will get multiple IRR issues. So that means throughout this life of the project, you are getting more than one IRR. The IRR can NPV ka bindu වෙන වෙලාවේ discount factor එකනේ. That is the IRR technically. In the non-conventional type projects, I will show you that is there in the later. So in the non-conventional type project, you will identify more than one IRR. So that is we call multiple IRR issue. For the conventional type project, you may not face that problem. You will have only one IRR. And also, in the conventional type project, When the IRR is greater than the cost of capital, normally NPV is positive or negative. When this IRR is greater than the cost of capital, NPV is positive or negative? Positive. In the conventional type project. When the IRR is less than the cost of capital, NPV is negative. When these are same, NPV is 0. So that sort of relationship you can identify for the conventional type project between the IRR and the cost of capital. Right. So then how to calculate this IRR? Before that, the characteristics. Consider time value of money. Yes, we calculate based on the time adjusted cash. Right. So that is also time adjusted cash flows are using. So that consider the time value of money. IRR assume cash flows are reinvested at IRR. Reinvestment assumption, implied reinvestment assumption here, cash flows throughout the life of this project, the cash generated through the project are reinvesting at IRR. So this IRR may not realistic. It might very far away from the market expectation. Some project के IRR है गोड़ा बड़ी इधर नमुत अपने कंपनी के मार्केट के लिए ने रेट ऑफ रिटर्न्स करता हम अपने कॉस्ट ऑफ कैपिटल के बड़ा बड़ा पाल लेंगे. So therefore, this IRR, reinvesting at the IRR, that assumption sometimes may not realistic. But anyway, technically, when we are generating the IRR, this is the implied reinvestment assumption. Cash flows throughout the life of the project are reinvested at IRR. Did you get that point? NPV, that is different. In the NPV calculation, cash flows of the project are reinvested at cost of capital. The cost of capital කියන්නේ market එකේ මේ තියෙන expectation එකට බොහොම ළඟින් යන number. That is very close to the market expectation. Investors require rate of returns. But this IRR may not be realistic, but what a problem. ඒක ප්‍රශ්නයක් නෑ. මොකද project එකේ IRR එක වැඩි වෙන තරම අපිට හොඳයි. වැඩි වෙන තරම හොඳයි. Because when it is greater than the cost of capital, you can accept the project. හැබැයි අපි අර ඒ රේට් එකට රීඉන්වෙස්ට් කරනවා කියන එක bit unrealistic. මොකද ඒ රේට් එකට අපිට එළිය ඉන්වෙස්ට් කරන්න බෑ. Because market cost of capital lower than that one. The market එක එච්චර ලොකු රේට් එකකට බැරි වෙන්න පුළුවන්. But this implied assumption with IRR reinvestment is that it's IRR. That is the meaning. Unusual cash flow pattern can generate multiple rate of returns for the non-conventional type project. Right? So you might face the problem we call multiple IRR issue. So if the unusual cash flow pattern, so that's like this picture. Unusual. Invest करना, लैंडना, I invest करना, I देना, I invest करना. So likewise, cash flows, the signs of the cash flows are changing more than one time. Pattern එක වෙනස් වෙනවා. So ඒ වගේ වෙලාවකදී you will get more than one IRR. ඒ කියන්නේ NPV එක, ඒ කියන්නේ project එකේ life එක තුල NPV එක බිඳ වෙන අවස්ථා කීපයක්. That is the multiple IRR issue. So you will get more than one. If NPV and IRR criteria disagree for the conventional type project, you can conclude your answer using the NPV. For the exam, if there is a disagreement, say IRR say this is the good project A, because its IRR is higher. But NPV say this is the good one. So kind of a disagreement you may face in the exam when you are answering for a conventional type project, you can go with NPV. You can conclude your decision with the net present value calculation. Always, when the NPV is greater than 0, NPV is positive, IRR is greater than cost of capital. Right? When the NPV is negative, less than 0, IRR is less than the cost of capital. So that relationship you can expect for the conventional type project between the NPV and the IRR. Any question? Right. So now we are going to calculate the IRR. So now you can recall the things you learned under the YTM calculation. Do you remember? You have to identify a range. So based on that range, you are doing the linear interpolation method. So approximately we calculate the YTM. So here also we are accepting the same method. Because technically IRR means it is the discount factor when the NPV is 0. ඉතින් අපි හොයාගන්න ඕනේ NPV එක බිඳුවෙන් තර තියෙන discount factor එක. That is the IRR. Yeah, trial and error method එකෙන් තමයි යන්නේ. That is the same methodology we are applying here. You have learned already. So let's look at this example. Let's calculate IRR with this one. Cost of capital of the project 60,000 and it's expected to generate cash inflows 20, 30, 40, 3 years. Calculate the IRR. So you have to calculate the IRR. So what is the method? We have to apply the trial and error method. Let's do together. In guessing discount factor, first calculate the NPV. See whether it is positive or negative. If it is positive, increase the discount factor to get the negative NPV. So likewise, try to identify a range where the NPV 0 is included. As much as possible, if you can narrow down the range, your approximation forecast with the linear interpolation forecasting will be accurate. So that is the way. So what is the discount factor we are using initially? No any hint for that. In the YTM calculation, there was a hint. What is the hint? If it is discounted bond, coupon rate less than the YTM. So likewise, there was a sort of relationship. Based on that, you can identify initial factor, initial discount factor. Now here there is no anything like this. So you have to start with fully guessing number. Let's start with 15%, 18%, 10%, 5%, whatever. So let's start with the 15%. So see, take the IRR as 15% and see what is the NPV. So at the 15%, NPV is equal quickly 20, 30, 40. So 20,000 you have to discount it using 15% for year 1, 30, year 2, 2 years, you have to discount back 40,000, year 3, 15%. So these are the present value of the cash inflows minus cost. It is 60,000. What is the NPV? What is the NP? Is it positive or negative? Positive, how much? 6,370. Positive, 6,370. 76. 76. Right. So now we have to decrease this because we need to identify another NPV with the negative in order to get the point where the NPV is 0. So in order to decrease this, you have to increase the discount factor. So what is the name? Make a value කරන්න ඕනද? මෙයා වඩු කරගන්න බැද? 20. 80. Positive let's calculate quickly about 18%. What is the NPV? So only thing you have to change now 15% with then 18%. See what is the NPV? It's positive, then. Positive 2008. 839. Then again, equity negative 22 negative 8. 122 and NPV when the main is another at 22%. Negative. Still positive. Negative. 1,422. 422. Right. So the range is okay now. So the range is okay now. So now you can do the linear interpolation using this tool. So our linear interpolation table is then at 18%. NPV is positive 2,839. So we are seeking discount factor here when the NPV is 0. If you take the 22%, it is negative minus 1,422. So this is the linear interpolation table. So based on these two numbers, approximately we can identify IRR, like the YTH, is equal, it's greater than 18%, less than 20. So 18% plus difference between the largest and the smallest value, this and this. So that difference is how much? 2,839 minus 1,422. So minus it will get positive. Get it? 4,261. For that difference, the rate was differentiated by 4%. So then, for this difference, it is 2,839. This 18% should increase by how much? So IRR is how much? Is it 20.67? 20.67. Now, suppose this project required rate of return is say 19%. What is your decision? Project cost of capital or the project required rate of return is 19%. Do you accept project? Huh? Suppose the project, now here this project cost of capital or the project required rate of return is 19%. So this is our IRR 20.6. This is 20.6. What is your decision? Do you accept in the project? Yes, yes. Because this is our minimum required rate of return from through this investment. This is internally generating 20.6 from this project. It is internally generating. This is intrinsic. May project එක තුලින් generate වෙන rate of return එක 20.6. 20.6. And now this is greater than the cost of capital, so you can accept the project. So you can compare this IRR with the project cost of capital to take the decision, as I explained earlier. I hope so. Right. Now, for the independent project, you know what is independent project? We defined at the beginning. For the independent project, there is no conflict between IRR and the NPV. There is no any disagreement between the IRR and the NPV. So now you can see this blue line is we call NPV profile for a particular project. Now in the here in x-axis you can see this is cost of capital R or the cost of capital or the required rate of return from the project. So here NPV in the y-axis that is NPV. So you can see if you take this point here cost of capital somewhere here, this is the project NPV. Right? At this point, you can see this is the cost of capital, this is the project NPV. So you can see NPV is positive at this cost of capital level. So therefore, according to the NPV project, you can accept, and also this is the point where the IRR, because IRR is the discount factor when the NPV is 0. IRR is the discount factor. NPV then මෙතන බලන්න මේ වෙලාවේ NPV කීයද? 0. NPV 0. එතන මේ තමයි IRR එක. මේ ප්‍රොජෙක්ට් එකේ IRR එක කීයද? එතකොට now at this cost of capital level අපි හිතමු මෙතන තියෙන rate එක යම්කිසි rate එකක් cost of capital level NPV is positive. You can accept the project. And also IRR is greater than the cost of capital. Metan the cost of capital, here IRR. So IRR is greater than the cost of capital, no problem, you can accept. Both are aligned, both are provide the same conclusion. Metan may level එක ගත්තොත් මෙතන මොකක්ද? Same. This is the cost of capital. So still project is positive. So IRR is greater than the cost of capital. So may point එක ගත්තොත් මෙතනක් තියෙනවනේ at this level මේ තියෙන්නේ cost of capital. At that cost of capital level, project NPV is negative. Then මෙතන තියෙන්නේ මේ හරියනේ, so that is negative. So then you may reject the project, and also IRR එක මොකද කියන්නේ? IRR is less than the cost of capital. So project should not recommended for the accept. So there is no any problem for the independent type project with the IRR and the NPV. But if it is a mutually exclusive project, what is the mutually exclusive? Mutually exclusive means when you accept in one, others is rejected. For the same purpose. We are evaluating for the same purpose. So that is mutually exclusive. Now suppose these two projects, right, L and S, suppose they are mutually exclusive. From these two, you have to select one. So these are the NPV profiles. NPV profiles mean actually for the different rates, different cost of capital level, you can calculate the NPV. ඒකල අපි මේ විදිහට graphically present කරන එක තමයි කියන්නේ NPV profile එක. Now this is for the project L. Then if you look at this two project L, S, 3 years. These are the cash flows expected. So you can construct the NPV profile at 0%, 5%, 10% cost of capital, 15, 20, so likewise. How is that? Excel here and then follow. Either at 0, if cost of capital is 0, project NPV simply is equal to the project undiscounted cash flows. At 0% cost of capital level, NPV is simply equal to its cash flow, undiscounted. Like 0 cost of capital. If you look at here, I had 150. The remaining cost is 100. 50. You can see at 0, this is 50,000. Make it take just for the information. Right. So likewise, you can prepare NPV profiles for these two projects in the Excel. So then these two NPV profiles you can present graphically like this. These are now mutually exclusive projects. Right. So this red line for the project L, this yellow one for the project S. Minimum point we call crossover point. Right? Crossover point. This is around May, but here if you put in the Excel, if you draw this graphically correctly, you will get crossover point is 8.7. So what is this crossover point? At this 8.7 cost of capital or the discount factor level, both projects are having same NPV. That is the mean. Crossover point rate you can see cost of capital at which net present value of the two projects are equal. There are cost of capital the discount factor. They came NPV saman. Project they came NPV saman. These are mutually exclusive. So you have to select only one. Cost of capital change depends on the market expectation, cost of borrowing, investors' required rate of return. This cost of capital is changing over the time. At the 8.7 cost of capital level, discount factor, both are generating same NPV. So that is the crossover point for this project. It is the point at which the NPV profile of one project crosses over or intersects the NPV profile of the other project. Are you okay up to this? Right. Now the problem with the mutually exclusive project, if cost of capital is less than the crossover point, become 5%. Then within the cost of capital is 5%. Then make a this is the NPV of the project L. This is the IRR for the project L. Then yellow line project S. IRR. Two projects. May up to May cost of capital level may project positive. We will take them as independent. Now, this is the cost of point. If you take the 5% cost of capital level, 5% discount factor. Now, this is 5%. There are minimum in the line. This is the 5%. NPV project L here, NPV project is here. Okay? At the 5% level, this is NPV. Purple line is the yellow one is the S. Either NPV L greater than NPV S. Is it correct? At the 5% level, we can crossover rate එක වඩා පල්ලෙහායි අඩු වෙනවා. අපි 5% කියන rate එක ගත්තොත් NPV project L and NPV L එකෙන් මෙතනනේ තියෙන NPV එක. This is the NPV of the project S. ඊට වඩා පල්ලෙහායි. Either NPV project L greater than NPV S. How about the IRR? So this yellow one is the NPV S. Sorry, IRR S. This is the IRR S. Either IRR එක වැඩි කොහොමද? IRR S greater than IRR L. Now can you see there is a conflict between NPV and IRR? If cost of capital less than the crossover rate, cost of capital එක මේකෙන් පල්ලෙහාට ගියොත් this is the crossover point. 8.9. If the cost of capital decrease or go below the crossover point, NPV say accept the project L, but IRR say accept the project S. IRR එක වැඩි නෙමෙයි. මෙතන තමයි IRR project S. NPV බිඳුවෙන තැන. This is the IRR project L. Either according to the IRR, they say project S should be accepted. මේ mutual exclusive දෙකෙන් එකයි ගන්න ඕන. Now there is a conflict. There is a conflict. Okay. Do you have any question? If you need anything, please ask. දැන් ඕකේ අනිත් පැත්ත බලන්න අපි මෙහෙට ගියොත් අපි හිතමු cost of capital එක 115. So at this level, may තියෙන්නේ NPV, this is project S, this is the NPV. So this is the NPV project S. Either NPV S greater than NPV L. Either IRR ගත්තම this is the IRRS project. This is the IRR project L. The IRR project S greater than project L. So no conflict. There is no conflict. No conflict. Because both NPV and the IRR say accept the project S. No disagreement. එතකොට disagreement එකක් එනවා කොයි වෙලේද? When the cost of capital it decrease the crossover point. The cost of capital, if it is greater than the crossover point, there is no disagreement between the NPV and the IRR. But if the cost of capital is less than the crossover point, this is the crossover point, there is a disagreement. Now, how to take the decision? This is happening with the mutually exclusive project. Do you need to explain this again? Anyone? Okay. Right. So now, and also I will explain how to take the decision. Now, if you look at this diagram, what you can see. Now, this is not a conventional type project. See here. This is the cash flow. Initially 1.6 you are investing. So you can see cash inflow. Here too again outflow. This is not a conventional type project. So now if you look at the NPV profile for this project, make an NPV profile later. Right? NPV profile. So look at here. 2 IRR. මෙතන IRR එකක් තියෙනවා NPV එක බිඳුවනේ. whether NPV binduva, you will get the IRR is 25%. And also here NPV 0. NPV 0. At the 400% IRR, NPV 0. And the 25% IRR, NPV 0. 2 IRR, internal rate of return. So that is we call multiple IRR company. So you are getting more than one. Actually, this is happening for this non-conventional type project. Alright, අපි කියපු conventional type projects වල මේ multiple IRR issue එක ඇති වෙන්නේ නැහැ. ඒතර මේ වගේ වෙලාවකදී අපි මොකද කරන්නේ? Now here also you have to take decision. Suppose our cost of capital is 5%. Our cost of capital is 5%. Now there is a disagreement. 5% level එකේදී මෙයා කියනවා L එක ගන්න, මෙයා කියනවා S එක ගන්න. Yeah, it's a disagreement. So this disagreement is happening because of that reinvestment assumption. Simply, I am mentioning that thing. So now there is a disagreement. This disagreement is occurred because of the reinvestment assumption implied in the IRR calculation. In the IRR calculation, you remember the reinvestment assumption was IRR. අපි කිව්වේ මෙතනදී මේකේ IRR එකට තමයි අපි ඉන්වෙස්ට් කරන්න කියලා. ඒතකොට මේකේ IRR එක ගත්තොත් මේ 23 20 මෙන්න මේ හරියට තියෙන්නේ. නමුත් අපේ cost of capital ගත්තොත් 5%. ඒතකොට the NPV reinvestment assumption is cost of capital. But when you are calculating the IRR, reinvestment assumption is IRR. So this IRR with this 5% cost of capital level, that is very unrealistic. It's very unrealistic. So therefore, you can see in the short-term projects, especially this kind of disagreement between the IRR and the NPV will arise because of this reinvestment assumption. The reason basically coming with the unrealistic reinvestment assumption with the IRR. So what you can do, you can calculate modified internal rate of return. So at the 5% level, you can calculate, now here at the 5% level, there is a conflict. So at the 5% discount rate, you can calculate modified internal rate of return. So with the modified internal rate of return, you can solve this problem. So what is this modified internal rate of return? Simply, it is the discount rate that causes present value of the project's terminal value equal to its cost. Right? So modified internal rate of return means, so we calculate terminal value of the project. Right? So terminal value means all the cash flows, we are compounding project cash flows to the end of the period. So then MIRR means it is the discount rate where that terminal value is equivalent to the cost of the project. That is the MIRR. So when you are calculating this MIRR, so reinvestment assumption is cost of capital. With the modified internal rate of return, our reinvestment assumption, so throughout the life of the project, we are reinvesting cash flows at the cost of capital. There are assumption issue sort out whenever. So then you can calculate modified internal rate of return. The modified internal rate of return is very simple there. The main project එක ගත්තොත් අපි මේ project එක අයිනවා terminal එක. අන්තිමට. So then we calculate the discount factor where this terminal value is equal to the cost of the project. That is the MIRR. So let's do with the example. So then we can realize. Any question? Question එකක් හදලා example එකක් හදලා Now look at the same project. So this multiple IRR issue you can resolve with the modified IRR calculation. On given capital valuation में इग्रामेंट के रिमेनिंग में प्रोडक्ट मात्रा में एडवांस रहते इधर यहाँ का बड़ा क्लियर हाई में के दस से ना बड़ा इन्वेस्टमेंट से ना बड़ा so but this is I'm addressing with the modified multiple IRR issue. So multiple IRR issue you can address by calculating modified internal rate of return. So let's calculate this one. Right. So this is our example. So we are calculating MIRR for the project. Now this is the project now. This is our project. 3 years project. 0, 1, 2, 3. Initial investment is 100,000. So we invest 100,000. Generating cash flows 10, 60, 80. 10,000, 60,000, 80,000. Required rate of return or the cost of capital given as 10%. So now we have to calculate terminal value. Terminal value means compounding value. Then this 80,000 we expect 3 years from now. That is the end of the project. So terminal value of this 80,000 is equal to this is end of year 3. This 80,000 generated through the project at the end of year 3. So the terminal value of this 80,000 is equal to I am compounder or not? Then you can take this 8,000 as it because terminal year ke end of year 3. Project ka output nahi vara. In a 80,000 you can take as it is. No need to compound. That 80,000 you have to consider. Now this is end of year 2. So its terminal value here 60,000. How many years you have to compound? 1 year. So that is cost of capital 1.1 into the power 1. This is 10,000. 1.1 10%. 2 times 1 2. So you have to compound for 2 times. Now calculate the terminal value here. $80,000 you have to add as it is. 60,000 into 1.1 means 66,000 at the high value 66,000. Then asunda අපිට ටෙලිම ගන්න වෙනවා. ඒතර මේකේ ටර්මිනල් වැලියු එක 10,000 20 12,100. So terminal value එක කීයද එන්නේ? එතකොට 100 6 7 8යි 14යි 158යි 100යි නේ 158යි. So modified internal rate of return means MIRR equal is the discount factor where this terminal value is equivalent to the cost of capital. That is the MIRR. So then modified internal rate of return you can calculate this 158,100 you have to discount 1 plus MIRR modified internal rate of return for how many years? 1, 2, 3. Project එක අවුරුදු 3යි. ඒතර මේක discount කරන්න ඕන අවුරුදු 3කට. ඒතර මේක the cost of the project is 100,000. මෙන්න මේකට සමාන වෙන වෙලාවේ මේ discount factor එක තමයි modified internal rate of return means. This discount factor. So you have to solve this formula for this discount factor. Cross multiplication එකක් දාන්නකොලු ඊට පස්සේ square root of 3 මම හිතන්නේ ගන්න ඕන. ඒක අපිට සුළු කරපුවම වෙනවනේ මෙහෙමනේ 100,000 into 1 plus MIRR into the power 3 is equal 158,100. The person may have MIRR modified internal rate of return into the power 3 is equal 158,000 divided by 100 किया है कहते तो बाहर आएगा 1.581 एनम मैं तुम्हें निकलगा ना मैं निकालूँ स्क्वायर रूट ऑफ 3 तुमने बात करोगे 1.581 मैं एक मेहाने को एक आर्गुमेंट में निकले इन MIRR is equal 16.5. Square root of 3, not the normal square root. यहाँ से नहीं का कट कर अपने के यूज़ करा में square root of 3 होती है। इन्होंने 16.5 is the answer. Right. So this is modified internal rate of return. So now you can compare NPV and the modified internal rate of return to take a decision. I will take only the 8 minutes. Right. Now in the for the other this one also for the project test you have to practice this, right? Already you take it down because no time to right? So you have to calculate modified internal rate of return for that also. Now if I go to this one, now here there is a conflict. Now there is a conflict here. If the cost of capital is 5%, IRR and the NPV, there is a disagreement. Now to solve this, what you have to do, using this 5% as the discount factor, right? Now here this is 10%. When 10%, instead of that 10%, using this 5% as the reinvestment rate, discount factor, you have to calculate modified internal rate. So then you can compare NPV and modified internal rate. I'm not going to that extent, but how to solve this? So what you have to do is that you have to calculate modified internal rate of return. So then you can see there is no any disagreement. NPV and the MIRR are aligned. Right? So that way you can solve it. Now, this is the reason, right? I extend these things. MIR correctly assume reinvestment at the opportunity cost. It's correctly assumed because now when you calculate this MIRR, reinvestment assumption is cost of capital. That is existing market expectations. So correctly assume the opportunity cost or the cost of capital reinvestment assumption. MIRR also avoid the problem of this multiple IRR issue. Then method of multiple IRR can project the terminal value making close scale outflow scale non-conventional so you have to calculate terminal value of the project. एक cost के समान में लगावे discount factor. If management wants to know the rate of return of the project, MIRR is the best estimate than the regular conventional IRR. Managers like the rate comparison, so you may go with the MIRR. So now I am just showing this one and I will stop this. At home, you have to do this calculation, right? I will give the answers. Now these are two projects. Very simple. A and B, cost 1000, 2 years. So you can see the net cash inflows. So you have to calculate NPV, IRR, MIRR for these two projects. Very simple. No time to calculate, right? Sorry for that. So you can calculate MIR for the project A. This is the answer, 16.8. 16.8. Using the same method. So these are the numbers. Now look at this. According to the NPV, project B is the better one. According to the IRR, this is the better one. But now there is a disagreement between the NPV and IRR. If you calculate the MIRR, so you can see these two. Both NPV and MIRR say project B is the accepted one. Right. So you may do this one. I'm no time to explain this one. I think from that this is over. So next week I will take 1 hour for the cost of capital structure. Then some question from the capital budgeting. I will plan this for the 3 hours. And then maybe 30 minutes for the model paper discussion. That way I will conclude the lecture. For your recording, you have to upload me. Nisala me LMS එක upload කරන්න පුළුවන් ඔයාලගේ recordings මේ limit එකක් තියෙනවා. හරි? අර නැත්තම් Google Drive එකක් විදිහට mail එකකට share කරනවද? එතකොට recorders 10 minutes right maximum 10 minutes එතකොට මම assess කරන්නේ ඔයගේ evaluation criteria මම share කරලා තිබ්බා. එතකොට දැන් ඔයාලට පොඩි risk එකක් තියෙනවා. Q&A එකක් අඩු වෙනවා. එතකොට so this is the evaluation criteria. So I will evaluate based on this sheet. Interviewing group එක නෑ එතකොට. I'm going to adjust for this time I am going report 50% readiness, presentation structure, then this is individual readiness as a group readiness, time management, then minimum 5 structure of the presentation. Report presentation එකට 10යි wait වෙන්නේ. එතකොට ඔයාලා මට 10 minutes වලට මේවා කරන්න. I will evaluate that and next week continuous assessment marks වෙනවා දෙන්න. ඒත් ඔයාලට අදහසක් ගන්න පුළුවන් continuous assessment කොහොමද කියලා. ඒකට කවද්ද? සෞද හවස් වලට අප්ලෝඩ් කරන්න තියෙනවා. පුළුවන්ද මට? याद कराना निकलना चाहते को कराना का big opportunity cost समझते हैं right Tuesday maximum जब सौदा वाला रिकॉर्ड कराना पड़ा रिकॉर्ड करला हम प्रेजेंट कराना ना वीडियोस ऑन कराना ना हम प्रेजेंट करना ऑल वीडियोस शुड ऑन So then අහනවද time එකක් කියන්න. මම IMS එකේ notice දාන්නේ නැහැ. By 6 o'clock evening then මට රෑට බලන්න ඕනේ. Tuesday, right? ඒතර date එක කිව්වා Tuesday කියන්නේ කවද්ද එන්නේ? Tuesday කියන්නේ 18යි 19 by 6 pm. I call කරලා කියන්නේ පාඩේ දාන්න බරුණා කියලා. හරි. එතකොට ඔයාලට මම fully flexible. I will evaluate and I will give the marks given next week. Any questions, any clarification? Sorry, I will take 8 minutes more.